Leaving Canada, CRA might hit you with a tax bill for the assets you have not even sold yet. I'm talking tens of thousands of dollars, even hundreds of thousands of dollars. And most people who have no idea it's coming. Stick around because by the end of this video, you will know exactly how to handle Canadian departure taxes and potentially save a fortune. Hi everyone, my name is Waqar Naqvi. And if you are planning to leave Canada, whether for a job opportunity, retirement abroad, or returning to your home country, this video could be the most important 15 minutes you watch this year. Here at Tax Return Filers, we have been helping Canadians navigate their departure tax planning for over 15 years now, right here in GTA and across Canada. We have seen it all, and today I'm going to break down everything you need to know about the departure tax in a way that actually makes sense. Before we dive in, hit that subscribe button and bell icon so that you do not miss our tax saving strategy. So what exactly is departure tax? Here is the deal. When you cease to be a Canadian tax resident, the CRA treat it as if you sold certain asset at their current fair market value. Even though you did not sell anything, this is called deemed disposition. Think of it this way. Canada is saying you have enjoyed tax referral on these gains while living here in Canada. Now you are leaving. It is time to settle up. But here is the question everyone asks me, Waqar, do I have to pay this right now? The answer is it depends. And that's where strategic planning comes in, which we will cover in a minute. In fact, one of our clients last year has faced a potential 87,000 departure tax bill. With proper planning, we help them defer a significant portion legally. That's the power of knowing the rules. Now you might be thinking, does this apply to me? Let me give you the scenarios. You are affected by a departure tax if you are moving permanently to another country. You are severing your residential ties with Canada. You have been living abroad and are now officially becoming a non-resident. Now the question arises, what are residential ties? We are talking about your home in Canada, your spouse or dependents in Canada, personal property and social ties, Canadian bank accounts and credit cards, provincial health coverage. Here is the truth. Residency determination is complex and the CRA looks at your entire situation. This is why we offer a free consultation at taxreturnfilers.com, because getting your residency status wrong can be incredibly expensive. Head to taxreturnfilers.com after this video to book your free consultation. We will review your specific situation and tell you exactly where you stand. All right, let's get into the meat of this. What assets are subject to deemed disposition? So stocks and securities, this includes shares in Canadian and foreign corporation, mutual funds, ETFs held in your non-registered accounts. If you have bought Apple stock for $10,000 and now it's worth $50,000, you will be taxed on that 40,000 gain when you leave Canada. Now, important to note, your RRSP, RIF, and TFSA are not subject to deemed disposition. You can keep these assets, accounts, and deal with them later. Real estate, except your principal residence, rental properties, vacation homes, vacant land, these are subject to deemed disposition. Your principal residence remain exempt under the principal residence exemption, but you need to report it. Capital properties, such as business asset, equipment, rental properties, if it would normally trigger capital gains when sold, it is on the list. What is excluded? Canadian real property, but you will have special reporting requirement for that. We'll talk about later. Business property for a permanent establishment in Canada, pensions like CPP, OAS, registered account like RRSP, RRIF, TFSA. Now here where people get tied up. Just because Canadian real estate is not deemed disposed doesn't mean you are off the hook. You still have reporting obligation, and when you do eventually sell, you will face Canadian taxes. This is exactly the kind of nuance our team at Tax Return Filers handle every day. With over 15 years of experience, we know every angle, every form, every strategy. Let's talk paperwork. CRA has specific forms for departure tax situation, and missing even one can lead to penalties, interest. So let's talk about Form T 1161, list of properties by an immigrant of Canada. This is your master list. You will report all properties you owned when you left Canada. This includes your stocks, every bond, every piece of real estate, even if it is not subject to deemed disposition. The deadline for that is April 30th of the year following your departure. Form T1243, deemed disposition of property by an immigrant of Canada. This is where you calculate the actual deemed disposition and capital gain. It is detailed, technical, and needs to be accurate. Form T1244, election under Section 220, subsection 4.5 to defer payment. So this is a magic form. If you are leaving Canada with significant unrealized gain, you can elect to defer the tax payment by posting security with CRA. Instead of writing check for $100,000, you can defer it until you actually sell that the asset. But here is the catch. You need to post acceptable security like a letter of guarantee from Canadian financial institution, and you will pay interest on the deferred amount. Other important forms: NR73 determination of residency status leaving Canada. This officially tells CRA you are leaving Canada. Schedule 3 where the capital gain and losses are reported on your tax return. Look, I will be very honest with you. These forms are complicated. One mistake, one missed checkbox, and you could face reassessment years later. This is why booking a free consultation at taxreturnfilers.com is so valuable. We will handle all of this for you, ensuring every form is filled correctly and on time. Now for the part everyone wants to know. How do you minimize your departure tax? So strategy number 1, crystallize capital losses before your departure. If you have an investment sitting at a loss, sell them before you leave. These losses can offset your deemed disposition gains once you are gone. Those losses become much harder to utilize. Strategy number 2, defer with Form T1244. As I mentioned earlier, you can defer payment by posting a security. This is powerful if you do not have cash on hand or if you plan to sell the assets at a loss. Let me give you an example. Suppose you have $200,000 in unrealized gain, tax owing approximately $50,000. Instead of paying now, you post security and defer. If the investment drops in value and you sell at a smaller gain later, you have saved thousands. Strategy 3, principal residence exemption planning. Make sure you have properly designated your principal residence for every year you are eligible. This exemption can save you from taxation entirely on your home's appreciation. Strategy 4, timing your departures. Sometime waiting a few months can make a huge difference. If you are retiring and your income will drop next year significantly, leaving in January rather than December could put you in a lower tax bracket for the deemed disposition. Strategy 5, consider offshore trusts. For those with significant asset, establishing certain structure before departure might provide benefit. Though this requires sophisticated legal and tax advice, here is what I want you to understand. Every single one of these strategies needs to be customized to your situation. What works for someone moving to the US for a job is completely different from someone retiring to Portugal or returning to India. At Tax Return Filers, we have spent 15 years mastering these strategies. We have worked with tax professionals, retirees, business owners, and families across GTA and across Canada. We know what works, and more importantly, we know that what the CRA is looking for. Go to taxreturnfilers.com right now and book your free consultation. We will analyze your situation and give you a clear roadmap. No obligation, no pressure, just an expert advice. So let's talk about some common mistakes you should avoid. Before we wrap up, let me share the biggest mistakes I see people make. One of the most common mistakes is ignoring the filing deadline. Form T1161 is due by April 30th of the following year. Miss it and you face penalties of $25 per day up to $2,500. Not fun. Incorrect valuation. You need fair market value for all the assets on your departure date. Guessing or using outdated number, the CRA will reassess you and you will pay penalties and interest. Failing to consider provincial taxes. Departure tax includes both federal and provincial tax. Depending on your province, you could be looking at a combined rate of over 50% on capital gain. Doing your taxes yourself. I respect people who want to do their own taxes, but departure tax, it is one of the most complex area of Canadian tax law. A single error can haunt you for years. These mistakes are 100% avoidable with proper guidance. So you have filed everything correctly and left Canada. What's now? You still have Canadian income tax obligation if you earn Canadian source income, such as rental income, you receive dividends, you sell Canadian real property, you receive RRSP or RRIF withdrawals, withholding tax rate applies. When you withdraw from your RRSP as a non-resident Canadian, withholding tax applies. 5% on the amounts up to $5,000, 10% on the amounts more than $5,000 and under $15,000, and up to 25% on the amount over $15,000. But here is a good news. If you are in a country where Canada has a tax treaty with, like US, UK, or Australia, you might reduce these rates. This is ongoing work. Non-resident tax compliance is a specialty in itself. And guess what? Tax return filers handle this too. We support clients even after they left Canada, ensuring they stay compliant and optimize their cross-border tax situation. Let me share a real example from our practice. Name changed, obviously for privacy reason. John came to us 3 months before moving to Singapore for work purpose. He owned $300,000 in stock, purchased for $150,000, a rental condo in Mississauga, RRSP worth $200,000. Without planning, the capital gain on stock $150,000, taxable amount 50%, $75,000, estimated tax margin tax rate up to 45%. the tax could be 33,750. Our solution, what we did, crystallized some losses in his portfolio, saved $8,000, filled Form T1244 to defer the remaining taxes with posted security, properly reported his rental property, not deemed disposed as Canadian real estate, set up a non-resident tax account for his rental income. Result, immediately cash saved 33,750. Long-term tax optimization, priceless. That's the difference expert planning makes, and it all started with a free consultation. All right, we have covered a lot today: what departure tax is and who it affects, the assets subject to deemed disposition, the critical form you must file, strategies to minimize your tax bill, common mistake that cost thousands, your ongoing obligation as a non-resident. If you are planning to leave Canada, you cannot afford to guess at this. The consequences of getting it wrong are severe. We are talking penalties, interest, reassessments that can follow you for years. Here is what I want you to do right now. Go to taxreturnfilers.com, click book free consultation, schedule a call with our team. In that consultation, we will review your specific situation, identify your departure tax obligation, create customized strategy, answer all your questions, give you peace of mind. And remember, we have been doing this for 15 years across GTA and all of Canada. Do not leave thousands of dollars on the table. Do not risk CRA penalties. Do not go through this alone. Visit taxreturnfilers.com today. I am Waqar Naqvi. I look forward to helping you navigate your departure from Canada successfully. If you found this video helpful, smash that like button, subscribe for more Canadian tax tips, and drop a comment below telling me where you are planning to move. Thanks for watching, and I will see you in the next video.